we talked about some drawbacks to mutual funds. There's definitely drawbacks. Let's talk about ETFs, or exchange traded funds. These solve a lot of problems that mutual funds have. So these aren't really as widely known. People don't know much about ETFs. Maybe they've heard about a mutual fund. An investment advisor would recommend that. They might not talk about ETFs. These are relatively new, at least in terms of financial community. These are new products, and they have a lot of potential, and they're already expanding a lot. So these certainly have a place in your portfolio, especially if you find mutual funds appealing. What is a mutual fund? It's essentially a pre-built portfolio somebody designs, or a committee, or smart people basically put together and do the work for you. You will pay them a fee. You will pay them usually a relatively large commission, but you get instant diversification and an instant portfolio. So that's what it is. They don't beat the market. It's just the reality of the business. Most mutual funds, for whatever reason, don't beat the market. As many of them don't. So if you're asking the question, if they don't beat the market, can we just buy the market? Instead of picking 30 or 40 stocks out of the 500 S&P, or whatever the case is, what if we just bought those 500 stocks? You can do that. You can do this right now. You can go off Monday and purchase one share of every single stock of the S&P 500, or make it easier. The Dow Jones Industrial Index is also tracked very highly. There's 30 stocks in that. You can purchase every single stock in the Dow Jones. You can do that, and that's the market. Cool, you can do that. But there's an easier way to buy the market, and it's called an ETF. But not really a catch. So you're not trying to beat the market. That's if the mutual fund, the goal is to beat the market. If the market's up 10%, the fund should be up 20. That's a lot of performance, but 12, 13, 14% minus the fee. But you're not trying to beat it. You're trying to be it. So the S&P goes up 5%. The fund should also go up 5%. There's nothing fancy about this. It really isn't. So it's the market. So you could go out and, again, same thing, buy one share of all those stocks in the S&P, which you'll pay 500 commissions. That's times $10 to get in and out. That's a lot of commissions. About $5,000 in commission. If your account's $10,000, that's not going to work. So that's not feasible for most people, nor does it even make sense. But you could do it. Okay, well, same thing. You can buy one share of it's like a stock. It trades under the symbol SPY. Remember, McDonald's was MCD. Netflix was NFLX, etc. So just go out and type into your chart or your program SPY, which sounds sleuthy, but nonetheless, it's the spider, called the spider for the S&P 500. You'll pay one commission. You'll pay whatever your broker charges, $8, $10, $20, whatever you'll pay. It's a very small annual fee, not 2%, usually around 0.5%, because somebody or some company is actually doing the management of these companies in the fund. They actually do put a fund together. So they do things, but they aren't picking, I'm not saying they have to be smart, that's not the right concept, but mutual funds are smart people. This is just basically rotating to what the S&P is. That's all they do. So you'll pay them about 0.5%. So that's not that much. If you want to beat or match the Dow Jones, which is 30 stocks, you'll just buy all of those stocks, pay 30 commissions, or buy one share of the symbol DIA. These are called diamonds, not that important, but DIA, purchase it, and you have the Dow Jones in your portfolio. Yeah, that's instant diversification. So you get McDonald's, you get Caterpillar, you get Microsoft, Intel, whatever you want to say in those 30 stocks, you get that in one transaction.